Hi everyone, I had to look at this market today from scratch. Knowing what I know about the tariff shock, the stalled Iran talks, the earnings repricing, and the way buyers are still behaving around record highs, I would not begin with the loudest question on the internet. I would not begin with, is the top already in? I would begin with something much more useful. What would actually have to break before we could say this is a top? Because that is where most traders get trapped. They see one ugly candle. They see one scary headline. They see oil twitch, yields firm up, tariffs come back into the room, and suddenly every chart looks like a disaster movie. But markets do not usually collapse just because people are nervous near the highs. They collapse when buyers stop defending the places they defended before. And right now, that has not fully happened. Now today is Sunday, May 3rd, New York time. Comment below what day and date you are watching from, because I want to see where this market conversation is reaching. And if you value this kind of breakdown, support the channel by subscribing and comment John A.G. Best below. That tells me you want more serious market work, and it helps this content cut through the noise. So, let us get into the real setup. Friday mattered, not because Friday destroyed the bull trend, it did not. Friday mattered because it finally forced the market to think about something beyond earnings. We had tariff pressure return, Iran negotiations stay unresolved, crude oil stay part of the inflation story, and yet the major indexes still finished the week with a lot more strength than most bears expected. The S&P and Nasdaq closed at record levels on Friday, helped by strong earnings and softer crude, while the Dow lagged a bit. That is the tension. The headline tape looked dangerous. The price action still looked resilient. And when those two things disagree, you do not guess. You observe who wins the next support test. The S&P finally gave us a real rejection candle after a powerful run. Price pushed higher, sellers showed up, and the close lost some of that clean momentum. That opens the door to a pullback. I would not be shocked if the market dips early in the week. Honestly, after that kind of move, I would prefer it. Markets need to breathe. They need to digest. They need to make late buyers uncomfortable and test whether real demand is still underneath. But a pullback is not the same thing as a trend break. A healthy market can pull back and still be completely fine. The key is not whether we go lower for a day or two. The key is whether we find buyers near the breakout zone or whether price accepts below it and then fails on the bounce. That is the difference between digestion and distribution. On the higher time frame, the market still has not done the kind of damage that usually comes before a major top. The monthly structure is still strong. The weekly structure still favors buyers. The broader sequence is still higher lows and higher highs. You can argue the market is stretched. You can argue it is vulnerable. You can argue the headlines are risky. All true. But stretched is not broken. Vulnerable is not confirmed. Risk is not reversal. This is where bears often get emotional. They draw a line across the top of a chart, call it resistance, and then act like the market has to obey it. But a trend line is not a legal contract. It is just a drawing until price confirms the rejection. Historically, the nasty breaks do not usually begin with one strong market sitting at highs and one candle looking tired. They begin after support fails, bounces weaken, moving averages roll over, and the market starts making lower highs where it used to make higher lows. We are not there yet. Could we get there? Absolutely, but we are not there yet. So my base case is simple. I want to see a controlled pullback, then a buyer response. If buyers defend the upper range and reclaim quickly, that supports the idea that this is just consolidation. If buyers do not show up, then I want to see the next bounce. A weak bounce under broken support is when the tone changes. That is when you stop saying buy the dip and start asking whether the dip buyers have finally run out of cash. Now, tariffs matter here. The new auto tariff pressure from Washington angered European officials, and the trade relationship is clearly more fragile than it looked a few weeks ago. Tariffs can hit margins, supply chains, pricing plans, and consumer demand. The market may ignore them for a while, especially when earnings are strong, but companies cannot permanently pretend higher costs do not exist. And Iran matters too. The latest proposal did not satisfy Washington, and the two sides remain split over the conflict, the nuclear issue, and control around the Strait of Hormuz. Oil eased after the proposal headlines, but the underlying standoff did not disappear. That means crude can calm down for a day and still remain a risk. So here is the counterpoint to the pure bull case. Yes, earnings are strong. Yes, technology is leading. Yes, the Nasdaq looks better than the S&P. But macro risk is not fake. Tariffs are not fake. Energy disruption is not fake. Sticky inflation is not fake. These things may not matter every day, but when they start to matter, they matter fast. That is why I do not want to chase blindly. I want pullbacks. I want reactions. I want proof. Based on recently published numbers, the earnings story has become the market's strongest defense. Analysts sharply lifted profit expectations after the mega cap reports, and reporting companies have been beating at a very high rate. That is why the market keeps absorbing bad news better than people expect. It is not because traders forgot about risk. It is because earnings have given them a reason to keep paying up. But there is a catch. When expectations jump that quickly, the bar gets higher. Good numbers become normal. Great numbers become expected. And if a company delivers merely okay results after the stock has already run, that stock can still get punished. That is why this week matters so much. We are heading into more reports tied to AI infrastructure, software, chips, data centers, crypto-linked activity, and high-growth tech. The market is going to ask whether this rally is being supported by real profit power or whether investors pulled too much future optimism into today. That is the earnings test. And right now, the Nasdaq is the reason bears cannot get too confident. The Nasdaq still looks cleaner than the S&P. The leadership is still in tech, chips, cloud, software, and AI spending. And technology led the major sectors on Friday, while energy lagged even with the geopolitical backdrop still unresolved. That tells you where the market's attention is. It is not saying oil does not matter. It is saying earnings matter more until proven otherwise. Semiconductors are still the heartbeat of this tape. Memory, networking, cloud infrastructure, chip equipment, and AI servers are all part of the same spending cycle. But do not confuse a strong theme with every stock being a perfect setup. Some names are extended. Some names need time. Some names are famous, but are not acting as well as the group. That is where traders get sloppy. They say chips are strong, so they buy anything with a chip label. No, you still need structure, you still need risk, you still need a place where you are wrong. Nvidia, for example, needs to prove itself if it is lagging the strongest parts of the group. Apple helped sentiment after results, but Apple alone is not the whole market. Microsoft, Google, Amazon, Broadcom, Meta, Tesla, and the software names all have different charts and different expectations. Google still looks like one of the cleaner large cap stories when cloud strength and price structure line up. Meta looks messier. Tesla can help consumer discretionary if it confirms, but it cannot just pop once and get a free pass. The market is selective, so we should be selective too. Now, breadth is the other big piece. If this rally was only one or two giant names, I would be much more suspicious. But lately, participation has been improving. Advancers beat decliners on both major exchanges Friday, and new highs comfortably outnumbered new lows. Equal weight measures, small caps, software, parts of industrials, and some defensive groups have all shown signs of life. That does not mean everything is healthy. It means the rally has more oxygen than it had before. The Russell is especially important because small caps are more sensitive to rates and financing conditions. If yields break higher in a serious way, small caps can feel that pressure faster than the mega cap balance sheet monsters. So I like the broadening, but I do not want to ignore rates. The Fed is not exactly handing bulls a soft pillow here. Inflation data has remained uncomfortable, and Fed officials are still talking cautiously about rate cuts. One official said the latest inflation figures were bad news and pointed to the need for more assurance that inflation is moving back toward target. That matters, because this rally is happening without the clean, easy rate cut story everyone wanted. If stocks keep rising while rate cuts get delayed, then earnings are carrying more weight. That can work. It is working right now. But it also means any crack in earnings expectations becomes more important, and volatility is another warning light to watch. The VIX recently moved back down into the mid to high teens, which usually supports risk appetite, but it can also signal complacency if everyone starts assuming nothing bad can happen. Low volatility is comfortable until it becomes crowded. Then one surprise headline can feel much bigger than it should. So the setup is not bearish, it is fragile bullish. That is a very different thing. Fragile bullish means the trend is up, but the market has less room for disappointment. It means buyers still control the larger structure, but they need to keep showing up. It means bad headlines can be absorbed, but only as long as earnings, breadth, and leadership stay intact. Now, if you are trading this, the plan should not be complicated. For the S&P, watch the first pullback into the breakout area. If price dips, rejects weakness, and reclaims quickly, that is the market telling you buyers still want it. If price slices through support and then cannot reclaim, do not argue, let it go. Wait for the lower high. That is where the short idea becomes cleaner. For the Nasdaq, I want to see leadership stay firm. If chips, cloud, software, and mega-cap tech keep holding up, it is very hard to make a dramatic top call. If those groups start failing together, then the market loses its engine. For the Russell, I want to see broadening continue without rates punching it in the face. Small caps do not need to lead every day, but they need to avoid rolling over in a way that screams risk appetite is fading. For sectors, I want to see more than just tech. Software strength helps, financials holding helps, industrials participating helps, consumer names joining helps. If the rally rotates instead of collapses, that is bullish. If you're successful, share your success story in the comments so others can stay motivated. The individual names should be handled the same way. Palantir is not a normal technical setup going into earnings, because one gap can erase the neatest chart plan on the screen. AMD and the faster chip names can keep working, but after a sharp run, the better entry usually comes from a pause, not from chasing the loudest candle. Memory names still deserve attention because data centers need storage, bandwidth, and speed, not just the headline GPU. Qualcomm, Marvell, ARM, and Datadog can all become interesting if they build tight ranges instead of flying straight into risk events. But here's the thing nobody likes hearing. You do not need to catch every one of them. You can miss half the moves and still do very well if you avoid the emotional trades that wreck your account. A clean pullback with defined risk beats a random breakout after everyone online is already celebrating. So I would keep a very simple dashboard this week. Are earnings revisions still rising? Is tech leadership intact? Are small caps holding up? Are credit and volatility calm? Is crude stabilizing or starting another inflation scare? Answer those questions, and the market will tell you a lot more than any dramatic prediction ever will. That is how you stay calm when everyone else is turning one red candle into a full-blown market crash prophecy. Very simple. Now, let us talk about the mistake most traders will make this week. They will try to predict instead of respond. They will decide before the support test happens. Bulls will say every dip must be bought. Bears will say every bounce must be shorted. Both sides will probably sound confident, and both sides can be wrong if they stop listening. The market does not care about your bias. It cares about liquidity, positioning, earnings, rates, and whether buyers are still willing to pay higher prices. So, is the top in? My answer is not confirmed. Friday was a warning tap, not a floor break. Tariffs and Iran added real uncertainty, but earnings and tech leadership are still holding the structure together. Breadth is better than it was. Volatility is calm. The Nasdaq still has strength. The S&P still has higher time frame support below. But if support fails, if the bounce is weak, if leadership breaks, if breadth reverses, if credit starts to crack, and if volatility expands instead of melting, then the conversation changes quickly. That is why the next move matters so much. Not the headline, the reaction. If buyers defend the pullback, this rally can continue. If they fail, we start watching for lower highs. And if lower highs stack under broken support, then we stop calling it digestion and start calling it distribution. Respect the trend. Respect the risk. Let price prove the next move. And please remember, this is for education and market perspective only. It is not financial advice, and I am not telling you what to buy or sell. Use this as one part of your own research. Understand your risk before taking any trade, and make decisions that fit your account, your time frame, and your life.